my name is Randy Sylvan, and this is the Accounting 102 Managerial Accounting Review for Chapters 9 through 12. One of the things I'd like to point out right away, and I'm going to share my screen with you, is this link. You can see this link. This will get you to the tutoring page website that has the Accounting 102 review packets in it. And I will stop sharing my screen hopefully you'll have written this down, but you can always, since it's a recording, you can always go back. Now I'm going to share my screen and show you what that looks like when I share that. So you'll get all of these review packets by chapter. So we're down here in chapters 9, 10, 11, 12. Each chapter has a little review packet which gives you explanations of everything that you need to know. And then there are practice questions for each chapter. And my review will pretty much be going off of these review packets. And then you can go back and practice the multiple choice questions as well as what you had from homework and quizzes. And also at the bottom here, there is a practice exam, which will be down here, the Unit 3 practice test. So you can go back and even have more questions to work on. So let me go to chapter 9, to the review. We're not going to really go through questions today. One of the other things I'd like to point out before we continue on is that when you take these accounting exams, it's key that you read the questions very carefully and watch for dates, watch for timing, and make sure that you can filter out the information that you don't need. So my suggestion would be to take the exam is go through all the questions that you can finish first, and then go back and get to the ones that you had trouble with. That way you don't really run out of time. So it's important to understand in chapter 9 what budgeting is. Right here, a plan for formalizing goals. The other issue here is management has a greater awareness of the operations. That's what budgeting does. It helps management make decisions. And then you really need to know where the budgets begin, and budgets are right here, begin with the sales forecast. Without the sales forecast, without knowing where the company is projecting their sales to be, you can't really go from the down to the bottom. So budgets are not generally built from the bottom up, they're built from the top down. Okay, you have to understand what a master budget is. You can see that right here, and that has all of the individual budgets underneath it, and it builds up to the master budget. And of course, the starting point is the sales budget. Okay. Now then, underneath that, we have the sales, production, and direct materials budgets. And the sales budget is simply this formula of expected sales times unit selling price equal total sales. So you may need that as you go along. Production is this basic formula here. What I want to point out with these formulas, though, is that you can manipulate these formulas algebraically to give you a missing piece. So if they give you in an exam 3 of the missing pieces, you can move these around to get you to algebraically to get to the missing answer. And they're all basically the same formulas. So if you look at sales, production, down here is direct materials. It's direct materials to be purchased times the unit selling price times the total equals the total direct cost of direct materials. Notice that's pretty much the same as the sales formula, and the production is pretty much the same formula down here for the units to be purchased, and the same really is true of direct labor units to be produced. As you go down further, the manufacturing overhead, which is important as well, is really kind of the same. You'll see when we have an example of that as we go forward. So I want to point out in manufacturing overhead, there's a variable and a fixed component. So we're going to have to deal with those. The variable portion of the it represents is dependent on the number of units that are produced, and the fixed cost depends on the total cost that management is estimating to be incurred for each type of fixed overhead cost. You can also have a mixed cost, which is a combination of variable and fixed. And then we also have to budget for the selling administrative costs. It also has variable and fixed portions that you will need to deal with. Okay. What I'd like to then point out now is the cash budget. Okay. You have cash receipts, cash disbursements, and of course, the difference between the two is whether you have excess cash right up in here or you're upside down and have negative cash. So if you have negative cash, you're going to need to potentially borrow. And you may see questions that have 3 of these, okay? So you may start with your beginning cash. It may say, here's your cash receipts, here's your cash disbursements. You may have to figure out what your excess cash is and if you need to borrow money. Okay, so it's important to be able to understand how this formula works. And again, along the way, there are practice questions that you can use to make sure you understand these, okay? And then I want to highlight the budgeting for non-manufacturing companies because, for example, we might have an accounting firm that we need to budget for, or a retail. In this case, they're showing a merchandiser, which is a retail. So like your normal store, the formulas are similar, but remember in a merchandiser, they're not really producing anything. So instead of the production budget, you're going to have the purchases budget. And nonprofits, they are based on cash flow, and nonprofits most of the time will budget from the ground up because they usually know their expenses and are not always sure what their donations are going to be. And so they have to figure out what they need to do to cover their expenses. Okay, so that pretty much covers chapter 9. Let's move on to chapter 10. Here's chapter 10, the review. This talks about static budgets. And what are static budgets? They're really based on just one level of activity. So it may be, maybe one level of sales and then working the expenses down below that. And it compares the budgeted to actual, which you'll see down here. It compares the budgeted actual results and takes a look at whether those results are favorable or unfavorable. Okay, so it's important. Then you have flexible budgets. So they're budgets that you look at that will accommodate different levels of production. They're flexed, again, to accommodate an actual level of production. You use variable and fixed costs and revenue formulas from the static budget to do a flex budget. Okay, so that's important. I would take a look at these steps below here, and I would also understand these formulas to understand how to get to the total budgeted cost. Okay, and then there's differences. The differences between how much expense should have been at the actual level of activity versus the actual amount incurred are what you are looking at. So you're comparing what the expenses came out would have been budgeted at versus what they actually were incurred. Okay. Let's go down to responsibility accounting, and we're down here, and it's based on accumulating and reporting based on the manager who has the authority to make the day-to-day decisions. So that's important. It puts the responsibility on a particular manager. It's valuable in a larger organization where they call it here decentralized, meaning there are lots of management areas throughout the company. Okay, so now we have controllable versus non-controllable costs right here. Whether cost of revenue is controllable, so all costs are controllable by top management, and as you go down to the lower levels of management, they become less and less controllable because each level of management has less and less that they're responsible for. Costs incurred directly at that level, though, are controllable by that particular manager. The management by exception, they look at the differences between what actually happened and what was planned. So they only look at exceptions. That's what the important thing to understand there is. We should know what a cost center is. It just has costs in it. It doesn't generate any revenue. You might have production or service department, and then you have profit centers. Profit centers, those are the areas that actually do generate revenue. You might have different departments in a retail store, for example. You may have different production lines in a production company in that area. Then you have investment centers. Those are the centers that control the fixed asset purchases, so equipment, and deciding whether we should buy new pieces of equipment, et cetera. Okay, you have this responsibility report. So understanding what a controllable margin is important. So understanding this formula, sales minus variable costs, that's what can be controlled, minus controllable fixed costs. So that's the contribution margin, which we've been used to discussing, minus any controllable fixed cost gives you the controllable margin. Okay, so you take into account first the contribution margin, then any controllable fixed cost. Okay, then we need to evaluate what we've got. So the return on investment is going to be the controllable margin, which we calculated above, divided by the average operating assets. And so that's taking assets at the beginning of a period, assets at the end of a period, and dividing by 2. Okay, so watch what can happen to whether you increase the numerator, which is controllable margin, or whether you increase or decrease the average operating assets. So if you reduce expenses up here, your controllable margin goes up, which will increase your ROI. If you reduce these operating assets, the same thing would happen. Your controllable margin over your average operating assets goes up. And so you may see some questions talking about that. Okay, so there's a couple of practice problems. I think you're going to need to understand what residual income is, and it evaluates what's left after subtracting the controllable margin from the minimum required rate of return that we're expecting. So it's controllable margin over minus the minimum rate of return times the average operating assets. So we take our minimum rate of return times the operating assets. That's how much we're going to use. So our controllable margin minus that gives us our residual income. And I would try to understand what these formulas are. Okay, so that takes us to the end of chapter 10. Let me go back here. We're going to start chapter 11. Okay, important things to point out here. This is all about standard costs. Okay, so it's very important to understand how we get to these standard formulas. I mean, I'm not going to repeat them, but you do need to understand, for example, standard direct material price times the standard quantity gives you the standard direct material price cost per unit. Same works for direct labor, manufacturing overhead costs, and you have to understand the standard predetermined overhead rate to get to these. So understanding these formulas is very important when you take this exam. Okay, here's all the advantages of setting standards. It's a great planning tool. That's the most important thing to know. It's useful for in setting the price. It helps management control costs, absolutely simplifies costing of inventory. So I would understand what these advantages of using standard costs are. The next step to look at are these variances, okay? So, you know, if you went back to your homework, you notice that we have a total variance, which is actual quantity times the actual price, and then you have the actual quantity minus times the standard price, and you have the standard quantity times the standard price. In the middle, the actual quantity times the standard price is the total variance. But the most important part is to break them down. You have the price variances here, okay, which is standard price, that's SP, minus actual quantity minus standard quantity. That gives you the price variance. The quantity variance, notice, our actual quantity minus times actual price minus standard price. If you add those two together, you get the total variance. Okay, so that's it. That's important to understand. And this is, it works for all direct materials. Okay, you can see these variances down here, but if you look at the material price variances and the material quantity variances, they're basically the same as the direct labor price variance and the material direct labor quantity variance down below here, which I'll show you. Right here, the price variance and the quantity variance, if you look at these formulas, they're basically the same. Okay, so it's important to understand that you don't have to memorize a lot of formulas. If you memorize one set, it will bring you through the whole thing. And then you'll need to understand whether a variance is sorry, I lost my train there. So you have to take a look at these variances and then understand what they actually mean when you're done with them. The same with the overhead. You've got overhead variances, gives you the overhead variance, and then you take a look at the variance reports. You have to understand in these variances whether they're favorable or unfavorable. We did a lot of homework in that area. You need to go back and take a look and make sure you understand once you calculate the variances for material, labor, and overhead, whether the results are favorable or unfavorable. Okay? Here's the overhead, the total overhead variance, but I would go back and look at your homework because the overhead variance is also split. And you can take a look at that. Now you have to understand what a balanced scorecard is. That really gives you financial and non-financial to help you assess what the performance of the company is and anticipate really what's going to happen. That's what gives you the balanced scorecard. So I would understand the definition of what a balanced scorecard is. Okay. So let's go down a little further down here. Then you have the overhead variances, which are you have the total variance here, actual overhead minus overhead budgeted. That's the total controllable variance. And then you have the overhead volume variance. And I would make sure you understand these formulas. If we were meeting live, it would be a great opportunity to explain and put some questions up on the screen, because I'm sure people may have questions. Okay. We go down a little further, we're pretty much ending with the chapter on variances, which is chapter 11. Now let's take a look at chapter 12. Okay, chapter 12 is all about cash flow, important for every single type of business. Okay, so as you go through these practice problems, make sure you get a very good understanding of the cash flow. Okay, so one of the things that you have to understand is cash flow, making capital budgeting decisions is all about, do you have enough money? Looking at various projects, which you did this in the homework, and understanding what the company's basic decision making process is, and then knowing what the risks are of each type of project that you're dealing with. So if you look down here, we have the cash payback technique, which is the simplest way. And again, it ignores the present value or the time value of money. So you look at the cost of the capital investment, you divide that by the net annual cash flow. That tells you how many years it's going to pay it off. That's a very smooth process when the net annual cash flow is projected to be the same each year. You really need to figure out what happens, because that doesn't always happen that way. Sometimes the cash flow varies year to year. So what you really have to understand is what happens when there's uneven cash flows. So what you do is you take the cost of your capital investment minus the cash flows for each of those years until the cost is actually covered by all of the net annual cash flows, and you can then convert that into the number of years that it took to pay it back. A little bit more difficult to get to that process, but still important to be able to understand how to do both. Okay, then you have the net present value method, a little bit more complicated. Okay, so it looks at the present value of the projected future cash flows and the present value of the net cash outflows, and compare it and using a projected discount rate. If you remember, you go back to the tables to get this information. So understanding how to use the tables. And remember that this method does not use net income. It really only uses cash flows. Okay, so we're not dealing with depreciation, which would be part of net income. Okay, and the higher that the net present value is, the more you're going to want to make that investment. You can go down these two formulas here. If you have equal annual cash flows, if it's equal, you're using the present value of an annuity because it's the same cash flow every year. You look up the discount rate, the interest rate that you were given, you look at that on the table, you go down to the number of payments you're expecting it to take, and you get a factor, okay? And you take that factor times the annual cash flows to give you the net present value of the net cash flows. Then you compare that to what your investment was, and that gives you the net present value. That's right here. So if that's positive, you would accept the project potentially. If it's negative, you would reject the project. You wouldn't use it because that means you would, if you accepted that project, you would lose money, and nobody likes to do that. If you have uneven cash flows, then you have to use the regular present value of one table and take each cash flow, like it says here, you find the given discount rate, and then for each year, you have to multiply the cash flow for that year times the discount rate for that year, add up all of the amounts that you just calculated, and compare that to the investment. So if it's positive, again, you accept it. If it's negative, you reject it. But you have to look. It's a little bit more tricky to do that, but certainly you've got the tools, knowing how to you understand how to use the tables, you'll be able to get through that fairly quickly. Okay, let's go down a little further. I want to point out the present value or profitability index, which is that net present value. So looking at when you rank the investments, I think if you remember, sometimes if you don't have enough money, you have 3 projects that you want to do, you don't have enough money to pay for them all, you want to try to find the project that you are going to get the biggest return on. So, so you look at the net present value of your cash flows divided by your initial investment. So values greater than 1, though the higher the value, the better. So value greater than 1 equates to a net present value greater than 0. Okay, the higher the value, the better. So if you were ranking 3 different projects, you would select the one with the higher profitability index. So I would make sure you understand how to calculate the profitability index. Okay, now I want to mention the internal rate of return, which is the capital. So to calculate the internal rate of return, or that interest return factor, is you take the capital investment divided by the net annual cash flows. That gives you a number, the internal rate of return factor. Now you go back into the table, find the number of payments, look across the column with the factor that you just calculated, and that will give you the interest rate. That's the internal rate of return. It's sort of going backwards, right? You take the capital investment divided by the net annual cash flow. That gives you the factor. You go find the number of payments, go to the column where the factor is calculated that's closest to what you just calculated, and that will give you, you go to the top then, and that will give you your internal rate of return. Important to understand that. Here is the annual rate of return method. It tells you whether the profitability of that capital expenditure. So in this case, you'll notice that the formula includes, first you calculate the average net investment, which is the original investment, the value at the end, and the value at the beginning. So the original investment plus the value expected at the end divided by 2, which gives you the average. Then you look at the expected annual net income. Okay, remember that's net income now, not just cash flow. So you may have some depreciation that you have to include in that calculation, and maybe some other expenses. Divided by your average investment gives you your annual rate of return. So I think it's important to understand that formula as well. And there are plenty of practice problems for you to take a look at. You'll see in these, there are a bunch of really good practice problems. So these are problems that are not multiple choice, but if we go back here, let me just share, for example, let's take a look at the Unit 3 practice exam. You'll see right here that there are 30, I believe, for each of these, and the answers, okay? So if you go back and look at 20 of these that you have, and then each chapter, let's look at chapter 12 questions just quickly. You'll see that there's 10. So if you go back and look at chapters 9, 10, 11, and 12, that's basically 40 practice questions. Let me stop sharing my screen here. Here we go. Let me stop sharing. Okay, so we're back here. You have probably 40, 10 for each chapter, and then another 20, so you have probably 60 questions that you have for practice. So again, going back, I would go to the link. I'll share that one more time. This link right here, you should see this. Make sure you copy that link. You can write it down, or you probably have to write it down and then copy it into your browser, and that will get you directly to the tutoring page. If you have any questions, reach out to your instructors, or there are tutoring sessions available. For example, I tutor on Mondays and Tuesdays from 3 to 7. Sign up for a tutoring session. Be glad to help you with any questions you have. If you want to send me a note on a question, my email is rs as in Sam, Y, L as in Llama, V as in Victor, AN at harpercollege.edu, and I'd be glad to help you as well. Good luck, and let me know if you have any questions. Take care.